Did you know that even after you're gone, you can owe up to 54% of taxes on your estate? Many Canadians don't realize just how significant taxes can be upon them. Today, we'll explore the most efficient ways to preserve your assets and ensure they remain with your loved ones, rather than being lost on taxation. We'll also share some real life examples, so let's get started. I'm Greg, the CEO of Dundas Life. With over 10 years of experience helping Canadian families with their life insurance needs, I'm here to talk about an often overlooked but essential topic: paying taxes when you die in Canada. When it comes to estate planning, most people think about the basics: writing a will, naming beneficiaries, or organizing their assets. However, one area that often gets missed is the heavy tax burden that can come with passing your will. Now, before we dive in, don't forget to subscribe to our channel for more content on financial planning and wealth management. So let's start by clarifying what is an estate. When you pass away, everything you own and owe forms something called your estate. This includes your home, investments, cash, and personal belongings, as well as any debts or liabilities you may have. Many people mistakenly believe that you stop paying taxes upon death. While it's true that you no longer have to file taxes after your final tax return upon death, your estate does face a final reckoning with the Canada Revenue Agency. This is due to a concept called deemed disposition. Deemed disposition means that the CRA treats most of your assets as if they were sold at fair market value on the day you passed. This fictional sale can trigger significant tax liability, especially for appreciated assets like investments or property. Imagine leaving behind a rental property worth $1 million. Do you know how much of that your family actually gets to keep? Let's say you purchased the property for $500,000, and at the time of your death, it's worth $1 million. The deemed disposition assumes the property was sold at $1 million, triggering a capital gain of $500,000. Half of that would be $250,000. That would be subject to tax. However, not everything is taxed upon death. Personal items, tax-free savings accounts, and your principal residence are generally exempt from taxes. Another key concept to note is probate. Probate is the legal process of validating your will and distributing your estate according to your wishes. In most provinces, there are probate fees, which represent a percentage of the estate's value. In Ontario, there is no probate fee for estates valued at $50,000 or less. For estates valued at more than $50,000, the probate fee is $15 for every $1,000 of the estate's value, or roughly 1.5%. For example, if your estate is valued at $1 million, the probate fee could be approximately $14,500. Later, we'll explore how smart planning can help you avoid some of these fees altogether. Luckily, assets with designated beneficiaries, such as RRSPs or Registered Retirement Savings Plans, and life insurance policies can bypass probate. This not only saves money, but also ensures privacy. Estate planning is essential if you want to minimize taxes and ensure that your assets go to the intended beneficiaries. One of the simple changes in your estate plan could save your heirs thousands. Stay tuned to find out how. Here are the key steps. 1. Create a will. This ensures your wishes are respected and avoids the courts deciding on your estate's distribution. What happens if you don't have a will? The courts decide, and it might not be what you'd want for your family. The process can also be costly, time-consuming, and potentially lead to family disputes. 2. Name beneficiaries. Registered accounts like RRSPs or TFSAs and insurance policies allow you to designate beneficiaries directly. This bypasses probate and ensures tax-efficient transfers to your loved ones. 3. Leverage the spousal rollover. If you have a spouse, the spousal rollover allows for tax-free transfers of certain assets such as RSPs or RIFs to your spouse. However, non-registered investments may still incur capital gains taxes. Consider setting up a trust. Testamentary trusts can be used to transfer assets while minimizing taxes and ensuring control over distribution to beneficiaries. Let's go over a few scenarios of how taxes are owed upon death. For example, if you have a $100,000 RRSP, it can be transferred to your spouse tax-free upon your death. However, if you have a non-registered investment or are not married, the account's full value becomes taxable as income. In Canada, the taxation rules can vary depending on the province or territory that you live in. If you own a cottage in Ontario and a primary residence in British Columbia, when you pass away, the taxation rules for the cottage in Ontario may be different from those for the primary residence in British Columbia. Another scenario to consider is that if you have a spouse who is a non-resident of Canada, in this case, the taxation rules for your estate may be different, and you'll want to involve a cross-border accountant in your estate planning. To save on probate fees, certain assets can be designated to beneficiaries. For example, registered retirement plans or RRSPs and life insurance policies allow you to name a beneficiary directly, which lets those assets bypass probate altogether. What's more, the probate process can often be time-consuming. In Ontario, it can take several months or even longer to finalize probate. This delay can create financial strain in your family during an already challenging time. If you have children from a previous relationship, taxes can lead to disputes over your estate if not properly addressed in a will. For instance, if one partner passes away and leaves everything to their children, the surviving spouse may feel left out and could contest the will, leading to stress and family conflict. This highlights the importance of clear communication and proper documentation. Having open discussions about your estate planning wishes with your family can help mitigate misunderstandings and ensure that everyone is on the same page. Taxation of specific assets. Now let's break down the taxation of different assets and how they're treated in Ontario. 1. Real estate. If you own property, your primary residence is exempt from capital gains tax, but additional properties, like cottages, are not. 2. RSPs and RIFs. These accounts are taxable as income in the years of death unless rolled over to a spouse. 3. Investments. Non-registered accounts may trigger capital gains taxes as well. For instance, if you have stocks or bonds that have appreciated in value, your estate may have to pay taxes on those gains. 4. Business assets. If you own a business, the taxation can become even more complex. The value of the business may be included in your estate, and if it's sold, the estate could face taxes on the gains realized from that sale. Understanding how taxes work when you pass away in Canada is crucial to planning your estate effectively. By knowing what can be taxed and how it's taxed and using strategies to reduce or avoid taxes, you can ensure that your loved ones inherit what you intend for them. Remember, estate planning is not just about taxes, it's about protecting your family and ensuring your wishes are respected. If you found this video helpful, subscribe to our channel for more content on financial planning for Canadians. Ready to take the next step in planning your estate? Every day you wait could mean more taxes and fees for your loved ones. Let's ensure your estate plan protects your family. Click the link in the description below to book a call with us today. Our team of experts is here to help you navigate the complexities of estate planning and ensure that your loved ones are protected. Thanks again for watching, and we'll see you in the next video.